Here they come. Up the road.
Just had the honor of talking to Treasury Department employees and thanking them for their hard work over the past 6 weeks in dealing with a serious financial crisis. I do want to thank the Secretary too. Mr. Secretary, you and your team have worked incredibly hard. You've worked with the Congress. You've worked with the financial markets, both domestically and internationally. I know that your people are exhausted in there. I really appreciate the fact that I'm going to sign a piece of legislation that'll be a part of, solving this crisis, an important part of solving the crisis. And so I just went up to thank people. Sometimes people in government never get thanked enough for all the hours they keep. And I've got a lot of confidence in you, Mr. Secretary, and your team. And I want to thank you for giving me a chance to come by, and looking forward to getting this plan in place. I just told the people in the Rose Garden that it's complicated, and we're going to make sure that whatever we do is done in a deliberate fashion and one that'll be effective and be mindful of the taxpayers. Appreciate serving.
Thank you very much, sir.
Appreciate serving. Thank you all.
Are you kidding me?
We'll hear from the head of the Federal Housing Finance Agency and Treasury Secretary Henry Paulson.
Good morning, everyone. I'm joined here by Jim Lockhart, Director of the new independent regulator, the Federal Housing Finance Agency, FHFA. In July, Congress granted the Treasury, the Federal Reserve, and FHFA new authorities with respect to the GSEs, Fannie Mae and Freddie Mac. Since that time, we have closely monitored financial market and business conditions and have analyzed in great detail the current financial conditions of the GSEs, including the ability of the GSEs to weather a variety of market conditions going forward. As a result of this work, we have determined that it is necessary to take action. Based on what we have learned about these institutions over the last 4 weeks, including what we learned about their capital requirements, and given the the conditions of the financial markets today, I concluded that it would not have been in the best interest of taxpayers for the Treasury to simply make an equity investment in these enterprises in their current form. I attribute the need for today's action primarily to the inherent conflict and flawed business model embedded in the GSE structure and to the ongoing housing.
This balance has been the ability to raise and maintain capital. Given recent market conditions, that balance has been lost. In order to restore the balance between safety and soundness and mission, FHFA has placed Fannie Mae and Freddie Mac into conservatorship. That is a statutory process designed to stabilize a troubled institution with the objective of returning the entities to normal business operations. FHFA will act as a conservator to operate the enterprises until they are
Fannie Mae and
stabilized.
Freddie Mac are critical to turning the corner on housing. Therefore, the primary missions of these enterprises now will be to proactively work to increase the availability of mortgage finance, including by examining the guarantee fee structure with an eye toward mortgage affordability. Additionally, under the terms of the agreement, common and preferred shareholders bear losses ahead of the new government senior preferred shares. Market discipline is best served when shareholders bear both the risk and the reward of the investment. While conservatorship does not eliminate the common stock, it does place common shareholders last in terms of claims on assets of the enterprise. Preferred stock investors should recognize that the GSEs are unlike any other financial institutions, and consequently GSE preferred stocks are not a good proxy for financial institution preferred stock. Preferred stock purchase agreements minimize current cash outlays and give taxpayers a large stake in the future value of these entities. In the end, the ultimate cost to the taxpayer will depend on the business results of the GSEs going forward.
Sometimes it just makes me sick, that just hearing about it and what they all did.
Where's the justice?
And so essentially what the bailout is designed to do is to make sure that these things get back on their feet. The bailout is not from the government's point of view to try to liquidate these things. And so if you then look at the case, that what happened is that the government took a 10% preferred, which became the senior preferred, the old preferred became a new junior preferred, there was still the common, and then the government took the right to acquire 79.9% of the common shares at about 0.00001 cent per share, which is not a lot of money at all, to put it mildly.
The Committee on Financial Services will come to order today. We have a hearing that is scheduled, oversight hearing, to examine recent Treasury and FHFA actions regarding the housing GSEs. I will yield to myself as much time as I may consume. Of course, the hearing that we have today is a hearing that is absolutely necessary based on the recent actions that stunned many of us with the takeover of Fannie and Freddie. Let me just say that when I first came to the House of Representatives, I was eager to be involved on the Financial Services Committee because of my concern for housing. And I was very pleased to learn about the mission of Fannie and Freddie, and very pleased to work with Fannie and Freddie as we help to find more ways to offer housing opportunities in communities that had been redlined in those days. I think the mission of Fannie and Freddie was a good mission then and should continue to be a mission that can certainly help many Americans realize the American dream.
Join my voice to those who agree that this is no time for finger pointing. It's actually time for all of us to try to work together to restore confidence and liquidity in financial markets and the American economy. But one of the things that I am concerned about is that housing financing efforts that have resulted in giving moderate to low-income people opportunities to be able to get into housing have come under attack this last week and been blamed for being the problem. I want to very soundly reject that idea. I plan on asking you about that, Mr. Director. I was hoping to ask about it yesterday, but I didn't get a chance to. I mean, I've even heard things like the Community Reinvestment Act is the cause of this current crisis, even though the Community Reinvestment Act only applies to commercial banks, does not apply to mortgage originators, who are the ones who originated the overwhelming number of these subprime loans. In fact, the CRA probably reduced the impact of this problem because they limited the ability for subprime loans to be issued through banks because they were regulated. Also today, you know, we've heard quite a bit of criticism of the Fannie and Freddie model. And I just want to remind my friends that Fannie and Freddie were pretty late to the game of accepting as part of their assets these more illiquid, these what we're calling illiquid assets today. In fact, the subprime model, which has been going on for a number of years, but Fannie and Freddie really added this as part of their business in 2005, 2006, 2007, which is late in the game. And so I just want to make it clear that part of what I want to make sure to do is to protect low and moderate programs programs for low and moderate income people to be able to gain housing. And I personally am not going to just sit by and let people trash programs that have helped folks get into housing who have been struggling to get it. Fannie and Freddie, I don't think are failed models. The CRA certainly isn't a failed program. These are important and good programs and should be protected. And if you want to find blame somewhere, let's look at Gramm-Leach-Bliley. Let's look at the very deregulation that so many people call for and clamor for, and now we've seen the full manifestation of what deregulation, lack of corporate responsibility, put together with flat and declining wages for the American people will bring about. It's brought about this. So I look forward to the debate.
I certainly understand your statement in the prepared testimony regarding your understanding that their regulator is willing to work with banks that may be put in a particularly difficult position by the lack of dividends. I think much of the frustration from those institutions, whether they held 5% of their capital in Fannie and Freddie or 20% of their capital, was that they felt that they were being asked, in fact, and saw the rules regarding the amount of the position that they could take be relaxed in order to try to be part of the solution. And having seen the regulators allow them to take bigger positions in Fannie and Freddie, they now feel, I think, a little bit more dispirited about where this has gone.
One of the things I'm interested in is right now, because of the conservatorship, it's my understanding that some private institutions, particularly banks in particular, I'm also interested in public pension funds, who in many ways were doing the right thing by investing in Fannie and Freddie, doing something that they're supposed to do, a safe, secure, good cause. Fannie and Freddie do good work, at least their mission is good. They were doing the right thing, but because of the conservatorship, they may be now technically in violation, possibly, of some of the capitalization requirements that they have. And pension funds, not capitalization requirements, but some of the underwriting standards that they're required to. And I know you're aware.
One of the key reasons that the financing was put in the way it was to protect the mortgage-backed security holders and the debt holders of these companies, that over $5 trillion. And that was so important to protect that exposure that we had to make a decision that there were some parts that couldn't be protected, and that was the common.
If everything works out the way we hope it works out, and people hold on to what they have. Again, I know there's some bumps in the middle of the road. In theory, there's no reason to believe that anybody in the final analysis should lose any money when this is all said and done.
At any rate, I think what I can say is that they still have some economic interest in this company, and going forward there may be some value.
The reason I bring that up is that here we have a very powerful federal agency that could have curbed a lot of the subprime abuse by eliminating the 327 and 228 teaser mortgages, and by eliminating the so-called cheater mortgages by requiring proof that a person has the income that he states on his mortgage application, yet they did not act. And the reason I bring that up is you are wanting to start yet another large, powerful federal agency and give it additional powers, and yet I just gave you an example of a situation where a federal agency with the powers to have stopped a lot of the subprime bleeding had the power but simply did not act.
You're right that across this regulatory framework.
Okay, I'm not asking for an answer because it was more of a comment. But it leads into the next question, is that now you want to set up this super regulatory system, give it the additional powers, to even seize institutions. My question to you is how many entities or companies can you envision having to be at in a position where they could be seized? Mr. Secretary, Hank Paulson, the former Treasury Secretary, wrote in his book On the Brink that encouraging banks to purchase these, and that this was done at the same time to help satisfy the Chinese government, which owned billions of dollars in Fannie and Freddie bonds, which were paid off in their entirety. And so now we have these banks that got that were intentionally misled, intentionally deceived to buy Fannie and Freddie preferred holdings, and then after the government said buy these, it's going to help out, government just defaulted and stuck all those banks. Big time. At the same time, you mentioned there's a new $30 billion capital program considering for community banks. And my question to you is, when I look at the objectives of reform, and this is a guideline, I don't see anything in there that addresses whether or not these community banks should be treated the same as the Chinese and be made whole when they were intentionally misled by the U.S. government to buy these bonds that turned out to be worthless.
Congressman, I cannot speak adequately to the judgments my predecessor made at that time. I can't.
I understand. I'm asking you, do you have a solution for these banks that got stuck?
Well, again, I think that one of the most powerful things we could do to help community banks get through the challenges still ahead is to put in place a capital facility that gives them the ability to come to the Treasury and apply for capital to support small business lending. I believe that would help make a big difference.
Well, I understand that, but if they're made whole on their bonds, they're just getting back their, no, if they're made whole on their preferred stock purchases, then they're simply getting back the money they paid in the first place and don't have to worry about another exotic program coming from the federal government.
Well, again, I understand those concerns, but small banks are right. I think
here we have a situation where my question is the Treasury, as part of its reform program, interested or willing to treat the community banks the same manner in which it treated the Chinese on making sure that they were indemnified on their bonds?
Well, again, I'd be happy to spend time with you, Congressman, in looking in more detail at that particular
Can you
suggestion.
give me at least the basis of an answer on that?
Congressman, we have put forward a very detailed.
If you don't know, I would accept that.
No, as I said, we think the most effective thing Congress could do to help small community banks now.
I understand that. I'm asking, what can you do? I mean, don't you think it's...
What I can do is administer a program like that with authorization from the Congress, but I need authorization from the Congress for it to work.
You need authorization. Would you need authorization in order to honor those preferred stock purchases?
I have to think about that and get back to you, but I have to get back to you about that.
Okay, that's fair enough. Thank you.
But now, Fannie Mae and Freddie Mac, I've been negative, but now I worry about it a whole lot less than I used to. See, I'm not so sure that any of this is really uninformed speculation. First, it's not like the SEC saying we got to halt trading these stocks. They shouldn't be stocks. Ultimately, they had to do that with GM. It's not like that. It's not like anyone from the company is saying, look, our business is worthless, we should be delisted. And without those caveats, I don't even know, I don't think we can say that buying in these stocks is uninformed speculation. I don't think we can do that, although I hear it all day. In fact, there was a fabulous piece by a guy named John Hempton. He's the chief investment officer of Bronte Capital. It's on thestreet.com today, where I'm chairman. It was all about how Fannie and Freddie, two stocks that I have said may be worthless, or at least Freddie and Fannie preferreds, could be worth a lot. The arguments were well reasoned. Housing bottoming, the portfolios aren't nearly as much trouble as people think. They might be able to pay the money back to the government and then have something left for the preferreds, maybe even the common. I mean, to me, it seemed like informed speculation from the guy who told us to sell Conseco before Conseco fell apart.
One of the things the state argued was that it would have taken a wide-ranging conspiracy of so many people to pull this off, and that there's just no way this could be possible. But in fact, that's not true. Really, 2 people could have done this easily enough if they had the motive to do it. Maybe 1 even. And the whole argument, well, why would they risk doing this and risk getting caught? You have to understand, they probably would have no fear of ever being caught doing this.
The whole thing was a nightmare. How do you think a man feels?
This was one of the biggest miscarriages of justice I ever saw in 20 years of criminal defense work and thousands of cases.
Everything what they did wrong should come back at them.
You gotta wonder, what's going on here?
Fannie Mae and Freddie Mac are also working through this challenging period. They play an important and vital role in our economy and housing markets today, and they need to continue to play an important role in the future. Their regulator has made clear that they are adequately capitalized.
Thank you. Let me begin, Mr. Secretary, because I was pleased to note your statement that you understand that the regulator at OFEO of Fannie Mae and Freddie Mac believes that they are now adequately capitalized. They are important institutions, and I think that was I'm pleased that you made that statement. I think that's important for people to understand.
But I believe part of this, of course, is confidence. And having been through periods like this, they always are the worst until they're resolved. And before they're resolved, you wonder how they ever are going to be resolved. But confidence has a way of returning to the markets. And over time, there have been many investors, wise investors, that have come in during times of great risk adversity and made investments and have made money on those investments. As I said, I believe the GSEs have played a constructive role, that they are playing a very important and vital role right now. They're responsible for, they touch 70% of the mortgages that are made in this country. And so they are a very important part of our economy, a very important part of our housing market. And they're an important part now, and they're going to be an important part in the future.
I agree that the GSEs are playing a critical role. They're, at this point, a very big part of the existing mortgage market. With respect to capitalization, I believe that they are well capitalized now in the sense of a regulatory sense, but I think as we've called upon all financial institutions to expand their capital bases so that they can be even more proactive in providing credit and support for the economy.
So these two institutions, which were vital to the mortgage market, were vital to the very integrity of the United States, and which had received, in this complicated Hanks problem, in a very short period before September, the watchdog agency that Congress had established to watch these two agencies had given them a clean bill of health. And that clean bill of health, it might be fun to go back and read that now. Well,
you know, people often ask, what is the Occupy Wall Street movement about? Well, it's about the bankers robbing us blind. That's exactly the kind of story we're going to cover today. Naomi Prince is with us, actually. She's a former managing director at Goldman Sachs, so her expertise here will be invaluable. But let me tell you what the story is first. It's actually about former CEO of Goldman Sachs, Hank Paulson, who was also Treasury Secretary for George W. Bush. Well, it turns out, and Bloomberg News is reporting this, and they've done a terrific job with this over the last couple of days. On July 21st of 2008, Hank Paulson was going and telling the whole world that Fannie Mae and Freddie Mac's books were being looked into, and don't worry, their examination will give a signal of confidence to the markets. But on the same exact day, he had put together a meeting at Eaton Park Capital Management of 12 of the top hedge fund managers in the world. What he told them was a completely different story. He told them Fannie Mae and Freddie Mac are in huge trouble. We are probably going to bring them into conservatorship, which means that we are going to do basically a government seizure of the firm. Well, that's a clear sign to any hedge fund manager that if you short that stock, you're probably going to make a lot of money because those people might not get paid off. In fact, first of all, William Black, who is a professor at University of Missouri, Kansas City, who was a former regulator during the S&L crisis, said, you just never ever do that as a government regulator. Transmit non-public market information to market participants. There were no legitimate reasons for those disclosures. So no matter why you did it, it's a terrible idea because they're going to make money on it one way or another if they have information that no one else has. So what wound up happening? Well, 7 weeks later, in fact, those two firms were pushed into conservatorship, and their various classes of preferred shares lost upwards of 85% of their value. But while they were losing value, the people who had bet short on them gained a tremendous amount of money. And were there more bets after the meeting? Well, you be the judge. On July 9th, there were 86.3 million shares of short interest in those two companies, meaning people betting against the company. So 86.3 million. After the meeting on July 24th, there were 262 million shares of short interest in that company, bets against that company. Obviously a huge increase in the bets that went against that company. Gee, I wonder how they happened to know that the company was in bad shape. Maybe the Treasury Secretary telling them made a bit of a difference. Those top hedge fund managers make a killing. Why? They knew the Treasury Secretary. In fact, 5 of those guys in that meeting were Goldman Sachs alumni. So that leads to the question of why did he do it? Naomi Prince is here to help us answer that question. Naomi Prince is a senior fellow at Demos. She is the author of the book Black Tuesday, which we've talked to you about before, and she was, of course, managing director at Goldman Sachs. So what's the official reason that somebody like Hank Paulson would say, well, I had to tell the richest guys in the world about what the government was going to do?
There's no good reason to tell those guys except to basically tip them off. I mean, that's what's going on here, because this is the Treasury Department. So it's not even like he was talking about the government. He was talking about himself.
Yeah, he's saying, I'm going to put the money in, right?
It's not the government over there. It's like me, the government, me, the Treasury Department, who is sitting here in front of you talking to you.
So, Naomi, what's the real reason he did it? I mean, there's 5 ex-Goldman guys there. He was head of Goldman from 99 to 2006. Is he just doing them an enormous solid?
I think honestly it's part of that. The old habits die really hard. These guys, they spend years being together. They spend years being like each other. They go to the same schools. They hang out in the same golf clubs. They are each other. And I think he'd been in the Treasury Department at that point only a year and a half. This is a way to sort of stay in touch. Who knows what's going to happen? Bush wasn't looking so good back then. Who knows where he's going to go? He has some material information that can help these guys out. You know what? The market knew Fannie and Freddie were in a bad position. The stock market for them was going down.
Right.
But to actually say, you know what, the government, i.e. me, is going to come in and take these guys over, that signifies a huge short, which you just explained also creates the volume for that short. And that's what he was doing. He was being his own self. These were his old guys. He was in a position where not only did he know this information, he was in control of executing this information.
Right, and Paulson, when he was CEO of Goldman Sachs, made about $500 to $600 million working with those guys. It's an interesting point you make. Look, he's the Treasury Secretary at that point. He sold off his Goldman stock and some Treasury bonds. But later, is he going to work with those guys again, make another $500 million? Maybe if he plays ball, right? I mean, there is no good reason to have done this. Now, as it turns out, if the guys acted on that insider information, it might be illegal for them. So some of them, including the guy who leaked it to Bloomberg, said, and his lawyer told him, immediately stop trading on Fannie Mae and Freddie Mac. Another guy held his position but did not add to it, worrying that it would be illegal. But it's not illegal for Hank Paulson, right? And isn't there a problem in that?
That's a definite problem. It's not illegal for Hank Paulson. It's not illegal for Congress people to know that there's information that they can affect. Not even that they hear about. Insider information can be heard about. This is information that they can actually execute. And yes, him in the position of a public servant, of an appointed person in a situation where the economy is in crisis, to go and basically tell his old friends, hey, here's how you can score on it, should be illegal. It is not illegal. That is one of many big problems in the system.
Right. And Nomi, look, isn't this exactly what the Occupy Wall Street movement is about? Like, we feel like we're getting robbed. There's these secret meetings among the 1%. And this is it. This is a secret meeting. This is how we get robbed.
This is it. Think about it. I'm not saying, the guys out there had any stock holdings in Fannie or Freddie, but you know what? If they didn't go short, they would have lost a lot of money while these other guys were making money. So it's not even that there's two sets of conversations going on. There's an extraction of money from people who don't know and don't have control to the people that do know and get the information. And that's a big reason why Occupy Wall Street is where it is.
Exactly right. And, people say like, oh, why don't you go get a job? It's not the point. The point is, why am I losing $124 billion and they're making billions because they've got the insider information? We're literally getting robbed by the 1%. That's the Occupy Wall Street complaint, and they're totally right about that.
And there's no better job than trying to point that out right now.
Yeah, absolutely. All right, Nomi Prince, thank you so much for joining us. Really appreciate it.
Thanks a lot.
Hello, and welcome to the Libertarian Podcast from the Hoover Institution. I'm your host, Troy Senek, joined, as always, by the Libertarian himself, Professor Richard Epstein, the Peter and Kirsten Bedford Senior Fellow at the Hoover Institution, Professor of Law at the NYU School of Law, and Senior Lecturer at the University of Chicago. Today, Fannie, Freddie, and your money. So, Richard, what sounds like good news last week, the U.S. Treasury reporting that it came in $118 billion in the black in the second quarter. But that money isn't all from spending cuts and tax increases. About half of it comes from another source. So what was that source, and why should it concern us?
Well, I mean, this is a complicated set of transactions, but unless you understand the fundamentals, you will not understand the extent of the heist that the Treasury Department and the Federal Housing Finance Administration, as it's called, are working with respect to the private shareholders of Fannie Mae and Freddie Mac. But to skip over a bunch of important intermediate events, by August of 2012, it becomes clear that the housing market is starting to perk up and that you can pay back essentially even this hefty interest rate and still be able to accumulate clear profits within the institution. At that point, this federal housing operation and the Department of Treasury enter into another deal called the Third Amendment to the Basic Transactions, in which they forget about the niceties associated with the preferred stock and simply say it is agreed by both sides that all of the money, net of certain minimum expenses needed to keep the thing going, shall be swept into an account by the Treasury. So there is now this huge dividend that is declared. And as you mentioned, half of that dividend, about $60 billion, gets paid in the 2013 second quarter. And the government reports that as income. So now what is going on is there are a bunch of legislation, Bob Parker of Tennessee and a congressman named Jeb Hensarling of Texas,
in their own separate ways, have basically proposed to reform the system by getting rid of Fannie and Freddie. And both of these proposals have in common the element that the shareholders of these operations should get no money out of this business. What happens is, and then I'll let you ask another question, is in response to this, there are now 4 major lawsuits that have been brought, 3 of them by people who are basically household names amongst lawyers, David Boies, Ted Olson, and Chuck Cooper, all of whom have very distinguished practices and a whole range of subject challenging this particular arrangement. And that sort of brings you up to where we are when I wrote my Defining Ideas column.
So what the Third Amendment does is it starts to change everything. But instead of having an amendment which is negotiated by a board of trustees or a director whose sole duty of loyalty is, as it is under corporate law, to the Fannie and Freddie shareholders, what happens is Ed DeMarco and afterwards Mel Watt both announced that they're representing the shareholders. But they're not representing the shareholders. They're conservatives. Their job is to maintain these particular assets, and they're supposed to bargain in a fashion which is adverse to that of the Treasury Department in an arm's length arrangement. But DeMarco is himself a former Treasury Department employee, and what he does in effect with this thing is to sign away the entire company. What happens is this Third Amendment comes out on the late afternoon some Friday. There's no evidence whatsoever of any financial work that had been done, any due diligence, any study by anybody telling this thing, and it becomes inconceivable that whatever the position is of the Fannie and Freddie, whether it's profitable or not profitable, it cannot be in the interest of the shareholders to say, we're giving you everything that we own in exchange for nothing in return. At this point, I mean, the salient facts that matter the most are that Fannie and Freddie took its last draw in late 2011. Freddie took it in 2011. Fannie took it in early 2012. So you have about a 6-month period in which there are no further draws, which makes it hard to say that there's a death spiral. And then within the next year, it becomes perfectly clear that $100 billion in excess money is paid over to the Treasury, which suggests that the financial situation did not change on August 18th. It was probably that way before this was done. And as Ralph said, if you don't publish your financials on time, it means that you're trying to conceal something rather than to reveal something. And so the government, I think, has to be put to the proof as to whether or not anything that it says is remotely true on the facts. And I think it's not. But it cannot be that when you strip assets from a private corporation, that you are immune from all sorts of liabilities with respect to the takings clause. If you can do that, the government could announce any corporation, in fact, has to surrender its assets by passing a statute which makes it the conservator of General Motors or Apple or any other company on the face of the globe. So now what happens in this particular case is the government does the following game. It says, look, we got control over this entity because we now are running Fannie and Freddie through FHFA. We've now run this sweep. And so what we've done is we've taken away all the dividends and we've taken all away the liquidation preferences. Well, there's nothing else that a corporation has other than these 3 kinds of interests. But it says, you know what, we haven't taken anything because we've left you with title to the shares. Well, if that were all that it would take, then the government could do this with respect to anything. And there's a very instructive case that you all ought to read from very early on called Pompelli against the Green Bay Company, in which what the United States government does is it floods somebody's land permanently, and then it says it doesn't owe any compensation for the destruction because it didn't bother to take the title. And what the court says, quite rightly, is not taking title is a terrible way to allow for massive evasions of constitutional responsibility, because when the government takes anything, it could always announce it leaves the title in the private owner and then takes all the beneficial interest for itself. Well, that's what it's done here. Right now, the shares trade at a positive price, but the only value that the shares have depend upon the ability to knock out the Third Amendment. If, in fact, the Third Amendment is good law, then the shares trade at 0.0 price because there's absolutely nothing whatsoever of value that's left in the corporation. And so if you can't do this title cognizable interest game with respect to real estate, you cannot do it with respect to corporations. And when the government puts forward this argument, it is just an open invitation for a complete kind of lawless behavior, which is really hard to understand. I mean, property law is kind of difficult. I'm certainly going to concede that. I spent the last 40-odd years of my career trying to understand how all of these systems get put together. But the kind of crude misunderstandings that pervaded the government's brief and that pervaded Lambert's opinion are not entitled to the slightest bit of respect. So,
there was no talk about a Third Amendment prior to August of 2012. The government never stated a position that they were going to sweep 100% of all the profits of Fannie Mae and Freddie Mac. In fact, virtually everybody had been wrong up to that point in time about Freddie Mac and Fannie Mae. They said they'd never be able to repay the government. In fact, as early as this morning, Jack Lew on CNBC made the comment that the American people don't think they've been paid back. I guess this is one of those dangerous things about a democracy because, I expect more than that out of the head of the United States Treasury. That's being created with the truth. They have been repaid back. They have been paid back. And so those investors had a right to believe the information that was presented to them, filed with the Securities and Exchange Commission. And we've made a big point in talking to this group. There are no small investors. There are no big investors. They're investors. And our laws were designed to protect individual investors. We have a right to believe. I'm here because I'm a registered investment advisor. I manage and advise people on over $1 billion worth of assets on a discretionary basis. I have over 276 individual investors that own Fannie Mae preferred shares. I believed what was printed in Securities and Exchange Commission filings. I've got a right to believe that.
Shareholder since 2009. I'm up here because I want to represent my family, my friends, my former coworkers, people that I told over the years before August 2012 that this was a good investment. And they relied on my guidance, and I did my best job to try and come up with an analysis that said this is a good investment. But then the government came along in August 2012 and changed the rules and said that they're going to take 100% of the profits. Even though they only own 79.9% of the shares through warrants that are unissued. At this point, the bailouts are cash flow positive for taxpayers. Pretty soon they're going to be accounting-wise positive. But the most important thing here is that we're here to represent people that couldn't make it, because there was a strong voice of anger and just we want to see the rule of law upheld for shareholders.
From Terrell, Texas. I'm a small farmer, and I kind of came late to the party, but I've always been aware of the importance of Fannie Mae and Freddie Mac, and been doing a lot of research on the history of it, and for 75 years it's been really the bedrock of the middle class and one of the contributors to the middle class. So I'm kind of tend to be into idealistic, and I tend to, and so this is more. I don't have a lot of shares. I can't afford a lot of shares, but for me, there's a really two big overriding principles, and one is that that without Fannie Mae and Freddie Mac, the middle class will be. I mean, they'll put more nails in the coffin. I firmly believe. And it's also been a tremendous engine for the economy over the years, and for the most part with quite a bit of stability. But the other thing is that this is a great country, and not everybody can own a big corporation, but everybody can buy a little piece of one. And when you can buy a little piece of a corporation, and I got into this stock because I found out that it was getting that Fannie Mae and Freddie Mac were getting profitable again, that they had a lot of tangible assets, and it's a viable company, and it should be going forward. So I really believe in it, and that's why I'm invested in it. And if you do that, if you if you buy a piece of a company and somebody tries to tell you that it's not worth something, then that really turns our whole system upside down, and I think it's really dangerous to do something like that. It affects the integrity of the system of private ownership.
I believe that the question was about the failure of Fannie Mae and Freddie Mac to recapitalize. And you have to go back to 2008, to build an understanding of this. Fannie Mae and Freddie Mac were put in conservatorship. And conservatorship is when one person holds title to an asset for the benefit of someone else. That benefit of someone else was always clearly the shareholders of Fannie Mae and Freddie Mac. And if that was impossible to do, the government had warrants to own 79.5% of all the outstanding shares of the company. So they had the ability to advance money at 10%, and they had warrants equal to 79.5% of the outstanding shares. So they effectively owned Fannie Mae and Freddie Mac if they wanted to. All they had to do under the terms of the conservatorship is to exercise the warrants. They could have done that at any time. And then the shareholders would have had to pay them back the 10%. Well, that's to be distinguished between receivership. And receivership is when you went into liquidation, when you go into liquidation. Well, by August of 2012, it had become apparent that everybody had miscalculated. Fannie Mae and Freddie Mac were far more profitable. They'd been advanced money that they didn't need. And now the government, when they really wanted liquidation, they were stuck with this thing called a conservatorship. They didn't want to own the shares, so they had no intentions of exercising their warrants. In fact, they still could. They could exercise their warrants to own 79.5% of the outstanding shares of Fannie Mae and Freddie Mac. And they could end this discussion, and then they could pretty much do what they wanted. But then they'd have to pay back the preferred shareholders. And then they'd have to put a value on the remaining shareholders. But they've chosen not to do that. What they did instead, in a complete turn of events, they created the Third Amendment. And the Third Amendment said, we're going to ignore everything we did, everything we've said since September 2008, and we're going to just take it all. And in the process of taking it all, we're going to liquidate. And there's been no mention of shareholder rights, no mention of anything at that point, from that point forward. So that's where we are, and that's the distinction. So when they say they can't recapitalize, that's not true. They have many different options available to them. There have been private sector support for even doing that.
Thank you everyone for being here, and thank you for giving us the opportunity to talk personally about why we're invested and why Fannie Mae and Freddie Mac are important institutions to us as individuals and to our company. I think Joe did a really nice job talking about the financial aspects behind this. I am also an investor in this company because I think it is a good move financially. This is a profitable company. I think that this, with the long-standing tradition that this company has, the importance it has to the American economy, I think it is a sound financial investment. Obviously, we've been through some tough times, investors that have been in this for a while. We've watched this stock price, climb and drop, but I have faith that capital follows the rule of law. It should follow the rule of law, and I think that as investors we can keep money in this company, capitalize, and move it forward to benefit everyone. I think there's a legislative outcome here that can benefit the taxpayers. Indeed, the taxpayers have already benefited. Over $40 billion above and beyond the loan value has been paid back. I think shareholders can benefit. Again, this is a profitable company. I think we can move forward with something where the share value can increase back up to where it was currently. And I think that there's a legislative option that can also benefit future homeowners. For those reasons, I'm an investor in Fannie individually, but I also want to talk briefly about the emotional investment in this company. In Minnesota, I'm a bankruptcy attorney. I specialize in Chapter 7 bankruptcies, primarily for individuals. And I cannot tell you, starting in 2009 is when I started my practice, I cannot tell you how many of my clients lost their homes or were close to losing their homes or had already gone through a foreclosure, and the one thing that they wanted was to be able to get back in a home. The housing sector is hugely vital to our economy. And what I'm seeing with my clients time and again is the value that they place on home ownership and how that affects their quality of life. So for those two reasons, I believe in this company. I'm an investor, again, financially and emotionally, and I think there's an option here. My goal on the Hill is to make senators, congressmen aware that this company can move forward. It's a solvent company. It needs to be released from the conservatorship. We are past managing and protecting assets here. We've conserved them. They need to be released back to the shareholders. Thank you.
And I want to call your attention now to another slide. I think it's already up. This specifically, again, from FHFA's regulations. It's regulations under conservatorships. And I want to read it. As one of the primary objectives of conservatorship of a regulated entity would be restoring the regulated entity to a sound and solvent condition, allowing capital distributions to deplete the entity's conservatorship assets would be inconsistent with the agency's statutory goals, as they would result in removing capital at a time when the conservator is charged with rehabilitating the regulated entity. That's the end of this case. That's out of the mouth of the regulator himself, of the conservator himself. And, Your Honor, if allowing any capital distribution out of conservatorship assets is inconsistent with the goals of a conservator, with its very raison d'etre, well, then what is allowing all of the conservatorship assets to be distributed in capital to a single shareholder?